full-time real estate agent in Northern Virginia. I have 14 years of experience of helping buyers and sellers with their real estate goals. And in this video, I would like to talk to you about getting ready to buy a home, and if you are ready, what the next step should be. Finding a good loan officer, finding out, I'm gonna talk to you about types of down payments, if you can buy with less than 20% or not. I will also talk about types of mortgages that are available right now on the market and what they mean. And I will touch on hidden costs of home ownership as well, because you want to be ready for owning a home and additional expenses owning a home bring with it. And I will also mention why you want to own a home as opposed to rent one, because a lot of people may tell you, oh, become a home ownership, it's always better, but you probably wonder why even bother with it. So I will tell you what the benefits of home ownership are. And with the expenses of home ownership, I will also tell you how to avoid some of them. And without further ado, let's get started. All right, so you're wondering if you are ready to buy a home or not. And for you to determine whether you are ready to buy a home, you need to ask yourself these questions. Do you have income for the last 2 or 3 years? It can be full-time job salary income, it could be business income, but you need a history of at least 2 or 3 years of that consistent income coming in to qualify. Is your income enough to cover your mortgage payments and other expenses associated with homeownership? Are you comfortable with paying that mortgage payment with the incoming money? Do you have money saved up for a down payment and closing costs? Because even if you can buy with zero down, but you still need cushion, a little bit of a cushion to qualify to get a mortgage. Do you have a history of work within the same industry? It doesn't have to be the same company, but it has to be the same industry in the last 2 or 3 years, because that's what lenders want to see. They don't necessarily, you can switch the job, it can be a brand new, even a offer letter, but as long as you've worked in the same industry for the last 2 or 3 years, you will be approved. Do you have long-term debts? Car loan, student loans, and you need to kind of try to pay them off before, well, not before, but the loan officer you'll be working with will tell you whether it's going to be a problem or not. But if you don't, you're much closer to qualifying. So if you answer those questions and you determine that you are ready to purchase a home, your very next step, and really the first step in the home buying process, should be finding a good loan officer that you can trust, and because you're going to be giving that loan officer a lot of your private information, and this is your biggest investment in life. So you want someone you trust. And to find that loan officer, you need to talk to your friends and family and see if they can recommend one they've worked with and they like and they love and trust. Or if you have a good relationship with a real estate agent, ask them, because every real estate agent has a loan officer or two that they've worked for years. For example, I have 2 amazing ones that I can recommend, and I've worked with them for years, and they helped many of my clients with consistently great terms and delivering what they promised to deliver. And that's very important. If you go online and you want to kind of fill out your information and see what other lenders have for you, be ready for bombardment of emails and phone calls from those lenders, because online websites sell your contact information to those lenders. So be very careful about it. I wouldn't even do it. I would just go through the family and friends route. Just remember, you need a loan officer you can totally trust. You have good rapport with them, and you can actually, bring them the paperwork that he's asking for, and a lot of it is going to be private. What if you determine that you're not ready to buy a home? Well, there are things that you can accelerate, the process of getting ready. If you don't have a consistent income, obviously you need to work on that. But let's say you have a credit history that's not up there, it's not good. There are things you can do to improve your credit. I will tell you a couple now, but your loan officer will be the best person to look at your particular situation and tell you exactly what you need to do personally. Not just like all general ideas, but you. And what you can do meantime is go over your credit report, all three bureaus, and see if there's any information that should not be there. Maybe you paid off a bill that still shows up as not paid. Or maybe some error was made and you're not even liable for that. So you need to go over and make sure there's nothing like that makes your score go down. A lot of the time I see people finding out they have a $10 medical bill from 10 years ago that really ruined their score by now. So really just be vigilant on that and just check your report and see what's going on there. Once you remove that information, the score will go up pretty significantly. The other thing you can do is if you are paying for everything with cash and you don't have your credit kind of built up because of that, you want to get yourself a credit card and you want to start charging everything on that credit card and paying off every month. So essentially you're doing the same thing that you're doing with cash, but you are building that credit. But remember, what the loan officers are telling us is that you shouldn't go over 30% of of the credit line in your balance. So keep your balance under 30% of your credit line. So for example, if you have a credit line with your credit limit of $9,000, do not go over $3,000 at any given point in your balance. So keep that in mind. As soon as you go up a little bit, your credit kind of gets a little bit of a ding. And the more you do it, the lower your score is going to be. So those are the things you can do, and then just make sure to talk to a loan officer about your own situation, and they will recommend the best way for you to improve your credit. And once you have yourself a good loan officer that you find, before you even go out and looking at houses, before you even go online and looking at pictures of the houses, you really need to get yourself pre-approved and get yourself the letter in your hands, because what happens is when we start looking at homes, there are so many good homes that you will find one you fall in love with. But if you don't have the letter in your possession and you still have to go through that pre-approval process, which takes days, several days, the home you fall in love with will go under contract, because remember, right now there is a shortage of inventory and there are a lot of buyers looking. So you want to be ready to put an offer on a house you fall in love with right away. And to do that, you need the letter. So the first thing you really want to do is get yourself approved, and only then you need to go out and start looking at houses. And that's where I come in as a real estate agent. I will kind of talk to you and see where you want to be, what you're looking for, and we will start working with homes. And I will start taking you out, and you will see houses, and you will pick one. And that's the home buying process. Let's move on to the conversation about down payments and types of mortgages, shall we? So you are thinking, okay, can I even buy with less than 20%? How am I going to save up for 20%? If I'm buying a $400,000 house, it's $80,000. How am I going to get there? Well, don't fret. Nowadays, you can buy with less than 20. You can buy with 10% down, 5% down, 3.5% down, and even 0% down. And the reason for that is we have 3 programs available on the market that are big ones, and then smaller ones kind of fall under those 3 big categories. And those 3 mortgages are conventional, FHA, and VA. So conventional is the loan for people with straightforward situation, with really good credit, good income, nothing complicating their situation like a side business or a person who's working, who has their own business. Conventional loan is your best bet, because if you have 20% down, you're going to have the best rate out there on the market if your credit score is high up. And remember, your rate is going to depend on your score and your debt to income ratio. But that's a conversation for another video, okay? We'll talk about it later on in a separate video. But so that's the conventional loan. But we do have conventional loans for with 10% down, even 5% down, even less than that. So it depends on the loan officer's access to different programs. The next one is FHA loan. FHA loan is a government-backed loan that allows people with a little bit of a lower score. Actually, the minimum score is way lower than conventional requirement, with less money to put down. FHA actually allows you to buy with 3.5%, and different states will have different programs available for residents. For example, Virginia has a program called VHDA. If you are in Virginia, if you want to know more about it, you just go to vhda.com. It's a class that you can take, but they help you with actually obtaining a 0% down payment loan. Of course, that's going to have to be FHA loan, but that's an option for you. And in any case, it beats having to save for years and years and years and become a homeowner with those programs available to you. And the other program is VA loan, and that's a loan for veterans. It's a Veterans Administration loan, and you have to be eligible for that. It's active duty or retired military are eligible, and that's a true 0% down loan with a VA funding fee, which usually gets rolled into the loan. So if you think that you are eligible for it, definitely reach out to me, and I will connect you with a VA experienced VA, specifically VA loan officer, and there are a lot of them out there that work with VA loans. That's a kind of a thank you for your service type of a loan that allows military personnel to buy with 0% down, and it's a really great program if you are eligible. Now, FHA loans actually are probably best bet for a first-time home buyer as well, because they do have some leniency towards that. If you didn't own before, there are some things that actually can get your rate lower than, let's say, conventional. Now, when you pick and choose which way to go, you want to talk to your loan officer and tell them, I want to pay this much a month. I'm comfortable with putting down this much for the down payment. I have this much in my reserves. Based on your particular requirements, your loan officer will tell you, oh, this FHA program is probably your better option, or this conventional option is probably your better for you. They will run numbers, and you will actually decide for yourself what program works better. And usually the numbers are very clear, because you will see exactly what your monthly payment is going to be on this program versus that one, and then you will, and what your closing costs are going to be, and you will be able to figure it out. The one thing that you really want to keep in mind, though, with all of these programs is, don't be surprised when you see the numbers and there's one item on that table that shows PMI. PMI is a private mortgage insurance, and that whenever you put down less than 20%, lenders want to protect themselves because it's a riskier loan, because you're not as vested into this home as opposed to somebody who puts down 20%. So they put a private mortgage insurance on top of that monthly payment to protect themselves. It's kind of an insurance for them if you decide to bail. That program, that PMI payment, can drop off as soon as your equity in the home reaches 20%. In some cases, you will have to refi to get it off. Some will just go off on them like automatically. In some cases, you will need to reach out to your loan processor, mortgage servicer, once you have those payments, to get them to drop it. And that's something you can absolutely reach out to us later on when you feel that, okay, now my equity is closer to 20%. What do I need to do? Just call me, and I will let you know what exactly you need to do based on whoever your lender is. So that PMI payment should not be a big surprise, again, if you're putting down less than 20%. Just be ready for that, okay? So I think that covers the mortgage programs. Again, if you have any questions on that, or down payments, or whatever about the financing, please reach out. Just call me or email me. And if I cannot answer those questions, I will connect you with a great loan officer who can, to at least get you the information you're looking for, okay? And let's move on to costs of home ownership and how to avoid some of them. All right, so you've determined you're ready to buy a home. You have your loan officer you're working with, but you're wondering, what am I getting myself into? Why even bother? And what are the additional expenses I should be expecting? Well, the reason you want to own a home really is when you rent, you are basically paying your landlord's mortgage for them, right? You're not getting anything back. You're just throwing money away every month. You don't have any income deduction. You have to ask for permission to do anything in the place you're renting. And you rent. It's not your space. And the main thing is you're throwing money away. So when you own a home though, first of all, you own the property that you own, right? You own and you can do whatever in it. You don't have to ask for permission if it's inside the house. If it's outside, you just ask for HOA to approve whatever project you want to put, like to add a deck or a fence or something. They just want to make sure your community is, consistent and kind of keeps value doesn't go down for everybody because somebody decided to paint their fence blue or something. And that's one of the hidden costs. Well, one of the costs of homeownership is HOA fee that covers a lot of the things that HOA does for you. So in addition to that, when you own a home, when your monthly payments, you make your monthly payments, and significant part of those payments are going to be interest for the mortgage that you're paying, especially in the first years, right? So that interest, actually every year the bank sends you a statement that says you paid this much money in interest, and that is a income tax deductible amount. So if you have a taxable income of, I don't know, whatever, that amount you've paid throughout the year is deducted out of that, and then your taxable income becomes lower. So you get your taxes lowered a little bit. And of course, if you want more details, I'm not a tax person. I'm not, you need to talk to a tax professional if you want to get detailed information on how it actually affects your taxes. I know it lowers them. Now, while you own a home as well, let's say you live in your rental place for 5 years. The rental place went up in price because market is improving and prices overall are going up. You're not getting anything out of it. Your landlord is, but you're not. But let's say rental market is improving and landlords every year tell you, okay, I'm increasing your rent, so either pay up or move out. Do you really like that? Do you want that to happen? Do you want that uncertainty of your landlord deciding to increase rent on you? I wouldn't. When you own, your monthly payment is fixed. Your mortgage principal and interest is fixed. The only item that's going to be increasing or decreasing is going to be your taxes and insurance. But in grand scheme of things, that's minor. Those are going to be minor changes. So, but your principal and interest for 30 years is not going to change. The house may go up in value significantly. You borrowed what you borrowed with the interest rate that you borrowed it with. So that portion is not going to change. And let's say you live in a house for 5-10 years and the market improved really nicely. Your house appreciates in value. Well, guess who's getting that benefit? If you decide to sell in 10 years, you get to pocket that appreciation. So, those are the nice things that you are getting with the home ownership, but there are some expenses you should be aware of. So let's go over them, shall we? So the first expense, of course, is going to be your mortgage payment, right? So it's going to be, principal, interest, taxes, and insurance. When you talk to your loan officer and they tell you your PITI, that's what it is. It's principal, interest, taxes, and insurance. Every year, your property is taxed. You have to pay taxes. And the mortgage servicer collects that money in every month. So they divide it by 12 and they collect it in your payment. And then they pay on your behalf twice a year to the county. For example, in Fairfax County, it's twice a year, right? That's the expense of you owning a home. You are essentially paying for that. That's a property tax. Now, that's a deductible amount from your income tax, just so you know. Another cost is insurance. Just like you have car insurance, you have to insure your house. And again, the mortgage servicer divides it by 12, collects it from you, and pays once a year to your insurance provider. So those are the expenses you should be ready for. We've touched on PMI, so PMI may be part of that payment, so I'm not going to go over that again. Now, another expense is going to be your HOA or condo fee, depending on what you own. If you own a single family home or a townhome and it says fee simple, that's HOA. You pay that HOA that covers street cleaning, trash removal, community club. Sometimes if you have a pool, it covers pool maintenance. It covers HOA, board meetings that they, once, I think a month, they get together and decide, okay, who wants to build fence, should we approve it or not. They basically, purpose of HOA is to keep community nicely appreciating in value all together, so that houses are all kind of consistent with the architectural rules that owners collectively decided to agree to. You get to voice, you get to also share your opinion at the meeting. So as an owner of the property, you actually get to participate in collective decision making about the community you live in. So that's another beauty of owning a home. You actually, get to participate in the community life. So the next, and then the condo, if you own a condo, and if you want to know difference between fee simple and condo, please reach out to me. I'll be more than happy to explain it to you. But if you own a condo, you will have a condo fee, and that covers more than just HOA, and that's why they're higher. They cover sometimes, most of the time, exterior maintenance, exterior walls, roof. If the condo has elevator, then elevator maintenance, parking, whatever your condo may have, that condo fee, kind of everybody pays condo fees to maintain the whole community. And that's why they're much higher than HOA fees, because it just covers more than in HOA. So you should be ready for that. And HOA fees range anywhere from $80 to $150 a month. Condo fees range from anywhere from like $300 and up, depending on the complex and the budget. And whenever you buy, by the way, whenever you buy a property, you will have a resale disclosure packet, which exactly shows you the amount you have to pay, what's covered, the budget, the financials. So you will have access to that information. And if you don't like something, you have the right to terminate the contract. So that's just something to protect you there. So you will have the opportunity to review those and decide whether you like it or not. And the next expense associated with home ownership is probably going to be, utilities for sure. But if you rent and you pay utilities, you kind of are familiar with them. If you're not, then you will have to pay for your own utilities: water, power, gas, cable, whatever else you may have, right? So just be ready for that. The next one is going to be your furnishings. You will be amazed how much empty space you get when you go from apartment, for example, to a townhome or a home. So you will have to fill it up, with time. And that's something that I, for example, enjoy doing. So it's something enjoyable, but it is an expense associated with home ownership. You will have to kind of go through that. And the last one I want to mention is landscaping, lawn care. So when you buy a home, you are responsible for your own landscaping or lawn care. So kind of be ready for that as well. When you rent, sometimes maybe if it's an apartment complex, you don't have to worry about it. When you own, especially if you own a townhome or a single family home, you own the land it sits on, and so the land has to be maintained by you. You're responsible for it. I think that's it. The big one, repairs. And I wanted to tell you how to avoid some of those costs, and this is the one that you can actually do something about. When you own, you are responsible for any repairs in your home, right? When you rent, it's landlord's responsibility, but when you own, that's up to you. And there are things you can do to protect yourself from the big item expenses when, let's say, AC goes out, or refrigerator breaks, or something really big happens and you don't have the budget for it. It's kind of a strain, right? The way to avoid that is to purchase a home warranty. And a good real estate agent that really takes care of you as a client will try, and usually in my cases it happens 95% of the time, to get seller to pay for the first year for the warranty for you. It's about $500 a year, but it covers pretty much anything in the house: plumbing, electrical appliances, AC, HVAC, which is the air handler. Sometimes it even covers garage door openers, doorbells. It depends on the plan that you pick. And what happens if you need a repair in that case is you call the warranty company and you tell them exactly what happened, and you pay a deductible. Usually it's about $100 per repair, not per number of visits, per repair. And warranty company sends out their tech, and the contractors that they send out either repair or replace the items that needs to be replaced. So let's say you buy a house, but AC is like 18 years old and it's about to die. It's working fine. You can't ask seller to do anything if it's working fine, but you know it's going to die on you. So that warranty actually protects you, because if that's the case when you own the house for the first year and you are covered with warranty, the warranty company will replace it or repair it if it's repairable. And so that's a nice thing to have, and that's the way to avoid those repairs hits, like costs, at least for the first year. But then later on you can decide whether you want to keep it. Then you just pay for it yourself on an annual basis and you are covered. Now that's not an insurance, that's two different things. Insurance protects you for situations like hail damage on a roof. Insurance will cover replacement of that roof, right? Or God forbid something happens to the house. That's where insurance comes in. Warranty covers repairs. So if it's lack of maintenance, or if it's old, or whatever it may be, that's what warranty is for, is to protect you for those times when you need repair. If you again want more information, reach out to me. I'll go over it more. But if I hope you have an idea about where to start, what's involved, and why even bother. And I hope I covered it in this video, and I hope you find it helpful. Please reach out to me if you have any other questions, and I would love to answer whatever you may have and help you out. Even if you're not in Virginia, even if you're not in my area, I will be more than happy to connect you with great real estate agents anywhere in the country, and sometimes even Canada. We have a great network of agents who help each other and kind of refer clients to each other, because we know we're going to do a great job for the clients we refer to. So feel free to reach out, and I will talk to you soon, hopefully in my next video about something else. Thanks. Bye.